This video is called Does Trend Following Work? Trend following has become very popular. Barclays Hedge estimates that assets managed by systematic trend followers has grown from 22 billion in 1999 to over 280 billion in 2014. So excuse the pun, but a lot of investors are following the trend into trend following. We will give you some basics about trend following and then look at the rationale for it working. We will look at a common moving average strategy, and then we will assess the evidence and make a determination on whether it can work. So what is trend following? Trend following basically means going long markets that have been rising and short markets that have been falling, betting that whatever the trend has been will continue. AQR, which is a well-respected quant shop, concluded that it works. They found trend following has delivered strong positive returns and realized a low correlation to traditional asset classes for more than a century. Trend following is conceptually similar to momentum, but there is a distinction. Trend following is time series momentum, like one instrument against itself, while momentum is cross-sectional momentum based on a security's performance relative to its peers. They are essentially the same principle, but just applied in different ways. So why might trend following work? Well, AQR concluded that the most likely candidates to explain why markets have tended to trend more often than not include investor behavior biases, market frictions, hedging demands, and market interventions by central banks and governments. Of these, we discount everything but investor biases because the others are things that are not persistent through time and too hard to measure with certainty and attribute the effects to trending or momentum. Now, investor bias is basically a fancy term for following the herd. Investors have a tendency to jump on the bandwagon whichever direction it is going. So that's investor bias. So think about whether you want to be investing just by following the herd. To show how this works, we will look at a typical 200-day moving average strategy, which is a common strategy. This strategy goes long the S&P 500 when it is above its 200-day moving average and moves to 100% cash when the S&P 500 is below its 200-day moving average. We use a 2-day lag from signal to implementation and compare it to a passive S&P index strategy. And the other thing we do is compare how it performs in up and down markets. So we separated those out, and this chart shows the up and down periods going back to 1950. The results are presented here based not on compound returns because that can get distorted depending on the start and end dates. We are looking at the average of the daily returns. We actually sum the log of the daily returns. And so that is a better way to see which one is a better strategy. So the top box shows a passive indexing strategy, and you can see the grand total, which is 482%. If you look at the 64-year average on the right-hand side, it's 7.53%. And that's an approximate average annual return. And you can see where it comes from. Because it's passive, you're going to suffer in the peak to trough periods. And so you gain 1,020% in the up markets, and you lost 538% in the down markets. That's in the yellow circle. Now, the 200-day moving average strategy is 488% in total, slightly higher by about 10 basis points per year than the passive strategy. It loses less in the downturns, it loses 169%, but makes less in the up markets, only 658%. The end result is not significantly different from the passive strategy, although the standard deviation of returns is quite a bit lower. If we went short instead of going to cash, it's slightly better than the basic moving average strategy, but the volatility spikes back up again. Here's the interesting thing. All of these moving average or trend strategies require you to pick some moving average, and some choose a blend, but they're all very susceptible to the choice of moving average period. Here are 3 examples compared to the 200. We have the 100, the 150, and the 300, and you can see how the performance changes when you change the moving average period. So none of these things are stable because it really depends on the choice of moving average period. You kind of have to get lucky that it goes your way. And if it works with 200, why should it not work with 150? So we are not a big fan of this, as you can tell. If we think it through, firstly, why should past behavior be predictive of future behavior? There is really no reason. Second, why should one moving average period be better than another? I mean, how do you pick one? Why is 200 so special? Why not 100? There is no basis to explain that. So as a fundamental investor, it doesn't make a lot of sense. And then lastly, ask yourself if you really want to be following the herd when markets are overvalued, because that becomes very dangerous. And we really like this quote from Ken Fisher from his little green book about market myths, which is pretty funny but true. And he asks, can you name 5 legendary momentum investors? And I thought about it, and then his response was, I can't think of even one. So I thought that was pretty good. So the key takeaways for this trend following are: 1, outcomes are very susceptible to the choice of moving average period. 2, behavioral bias is the main reason given for why it may persist, but we don't think that is good cause to follow suit. Investor behavior can change, it's not a stable parameter. Particularly troublesome is that trend following on the wrong side of valuation is a very hazardous strategy. There is no substitute for fundamental investing, that is buying a $20 company for $10. That's real investing. Buying a $20 stock for $25 because trend followers have pushed it up is not smart, because you need to get out of the way before reality sets in. So in our research, we have actually identified specific environments when trend following can work, but you have to be cognizant of valuations. And so we're not a big fan of trend following. We use it very sparingly for some things, but we do not think it is a basis on which to allocate money on. Thanks.